You might think a single form 1099K is just paperwork, but it can be the spark that starts a chain reaction leading to an IRS audit. What if I told you 5 routine mistakes almost every online side hustler makes could dramatically increase that risk, and that the fixes are often shockingly simple? Stick around, because the last one will save you cash and sleep. The IRS has been modernizing and expanding third-party reporting, and that means platform payments are more visible than ever. Today's breakdown is educational only, not legal, tax, or financial advice. Consult a licensed tax professional for guidance specific to your situation. Over the next 12 minutes, I will expose 5 red flags that trigger audits for online side hustles, show real numbers and examples from recent IRS changes, and give clear, actionable fixes so you can audit-proof your hustle. I'll also reveal the single record every side hustler needs to keep and why it matters. Ready? Let's dive. When a platform sends a Form 1099K, the IRS gets a machine-readable copy. The underlying tax rule never changed. All taxable income must be reported, even if you didn't receive a form. Here's the headline numbers. The IRS delayed the $600 automatic reporting rule and phased implementation in 2023. Many filers only received 1,099Ks if they exceeded $20,000 and 200 transactions. For 2024, the IRS planned a $5,000 threshold, and for 2025, a $2,500 threshold was announced as part of transition guidance. But here's the thing, even without a 1,099K, you still owe tax on the income. So when platform reports and your Schedule C don't line up, IRS automated systems can generate a mismatch notice, usually a correspondence audit letter. How does that look in practice? Imagine a side hustler who received $12,000 on an app that did not issue a 1,099K under the old threshold, but only reported $8,000 on Schedule C. That $4,000 discrepancy is a red flag. What do you do? Reconcile gross receipts to the platform amount by documenting fees, refunds, and cost of goods sold. Next, the deductions that scream "audit me." Claiming legitimate business expenses is fine, but excessive or vague deductions draw attention. The IRS looks for unusually large amounts relative to reported income. Think of a gig worker showing $2,000 in income, but $2,500 in vehicle deductions? That's suspicious. Deductions like meals, supplies, and home office are frequent triggers because they're easy to overstate and hard to prove after the fact. What's the fix? Keep contemporaneous receipts, a mileage log, and records showing business purpose. For vehicle use, a mileage log with dates, miles, and purpose beats a shaky memory. If you sell goods, maintain purchase invoices and cost of goods sold calculations. And if you spot an error after filing, consider amending the return. The IRS often prefers voluntary corrections to enforced adjustments. Next, what about repeated losses? Running a side hustle at a loss for years in a row raises one big question for the IRS. Is this a business or a hobby? The tax code expects a profit motive. Historically, hobby loss rules are a major audit trigger when losses persist without reasonable steps toward profitability. Picture an online seller showing business losses for 3 consecutive years while also posting vacation photos, red flag. The practical test includes factors like profit history, time invested, and business-like behavior. So what should you do? If the activity isn't profit-oriented, don't treat it as a business on your return. If you intend it to be a business, document pricing strategy changes, marketing efforts, and steps taken to increase profits. Keep a timeline of business decisions. Classification mistakes can go the other way too. Online marketplaces make it tempting to list personal items and call the proceeds business income, but selling household stuff occasionally is generally not taxable business income. It's a personal sale. The danger is misclassifying frequent personal sales as business revenue or inflating expenses tied to those sales. For example, flipping a handful of old clothes once a year is different from running a resale operation. The solution is simple but often neglected. Clearly separate sales records for personal items versus inventory. Document acquisition costs and the reason for sale. If it's a hobby, Don't claim business deductions that aren't allowed. Next is a deduction that can be a knockout if mishandled. Home office and vehicle deductions are powerful but require evidence. The IRS expects you to show square footage, exclusive use, actual expenses, and contemporaneous records for home office, and detailed mileage logs for vehicles. For inventory, inadequate documentation of cost of goods sold is another common trouble spot. Here's a concrete example. A delivery driver claims a 10,000-mile business year but has no mileage log, just a vague estimate. The IRS disallows deductions lacking records that creates adjustments and possible penalties. So now, what exactly should you keep? Maintain a home office worksheet showing measurements, receipts for utilities and repairs, and a calendar proving exclusive business use. For vehicles, use an app or a paper log with date, miles, start and stop locations, and business purpose. For inventory, keep purchase invoices, receipts, and sales records. There's another system-level shift raising visibility. Beyond individual mistakes, the IRS has more data and better tools than before. The administration of Form 1099-K reporting changed under recent law, and the IRS phased implementation to avoid chaos. Estimates suggested millions more 1099-Ks would be issued under a $600 rule. The IRS provided transitional thresholds and guidance instead. That increased visibility means simpler mismatches can trigger correspondence audits. But here's the thing. Most audits remain correspondence. Audits handled by mail and audit rates for individuals are still very low historically, under 1% overall. The practical takeaway is not panic, it's preparation. Reconcile your statements annually, keep 3 years of records at minimum, and respond promptly and professionally to any IRS letter. There's a single record that beats most audit headaches. If you're wondering what to do tonight, here's a checklist that prevents 80% of common problems. First, report all income even if no 1099 arrived. Second, reconcile platform 1099-K gross receipts to net income by documenting fees, refunds, and cost of goods sold. Third, keep separate bank and credit card accounts for business. Fourth, maintain contemporaneous records, receipts, invoices, mileage logs, and a basic spreadsheet or bookkeeping app. Fifth, if you realize you missed income or overstated deductions, consider amending voluntary corrections, reduce penalties in many cases. The top record every side hustler needs is a reconciled annual statement showing gross platform receipts, fees and refunds, cost of goods sold, and net reported income. That single document lets you answer most IRS questions in minutes instead of weeks. Let's recap fast. 5 red flags are mismatched or unreported income, excessive or undocumented, Schedule C deductions, repeated losses suggesting a hobby, misclassification of personal sales, and large vehicle, home office, or inventory deductions without substantiation. Systemic changes to Form 1099-K reporting mean higher visibility, but most audits are still correspondence and avoidable with good records. The essential habits are report everything, reconcile platform reports, separate finances, and keep contemporaneous documentation. Remember, this is educational information only, not legal, tax, or financial advice. Consult a licensed tax professional for guidance specific to your situation. If this helped, smash the like button so other side hustlers can find these fixes. Subscribe and hit the bell because next week's video will go deeper with a downloadable guide on the top 7 audit-proof records every side hustler needs. If you got a letter from the IRS and don't know what to do next, pause, breathe, and document everything before responding. Questions? Drop one in the comments with your scenario and the video will cover common patterns in an upcoming Q&A. Thanks for watching, stay organized, and keep that side hustle profitable and audit ready.